Welcome everyone, another episode of Financial 15. Kevin and I have lots of information today. In a prior video, we talked about what happens with registered accounts when someone passes away, who pays the tax. Today we have a similar question, but with joint accounts. Who pays the tax? We're going through the details. You want to stick around.
Yeah, another topic that a lot of people want to know information on and aren't really too sure of. And like I say, we've mentioned before, as Clint said, we've dealt with beneficiaries and who pays the tax on registered stuff. Today, we're dealing with more non-registered side of the thing. So if you get a chance and you want to find out this or see any of the other videos we've done, go to our website at beckerorr.com or like us on Facebook, or in particular, visit our YouTube channel. We have all our videos there that you can catch on to. So now we want to start this. Clint, joint accounts, this is non-registered stuff. Who's paying the tax on all of this in case something happens?
Absolutely. And there's two ways we can look at it. I'll dive right in, but there's going to be the ongoing tax, and then there'll be the tax if one of the joint partners passes away. And we'll tackle both of them there. But just to point out, there's going to be two different types of tax that we have to worry about. We'll start with the ongoing tax. And an important point here, Kevin, we're talking about joint accounts with rights of survivorship. There's different types of joint accounts. I imagine this is the most common, at least it's the one we see the most. So I think it'd be most applicable to talk about that. Joint accounts with the rights of survivorship. So if you have tenants in common, different topic, we're talking about rights of survivorship. Why don't you walk us through the details here?
Yeah, basically that's the main thing. It's usually the most popular aspect, as you say, having it with right of survivorship. And we want to do that because that helps out with the tax system going forward. So as we can see on this sort of example, the taxes according to the proportion, they can be optimized for the ratio. So if we had a joint account between two people, we're using Bryce and Darlene here. Bryce contributes 60, Darlene contributes 40. And over the course of that year on the 100,000, they earn $10,000 in taxable income. That could be dividends, capital gains, interest, as we mentioned here. Basically, what you should be doing when it comes to taxes is splitting it in the proportions that you have put the money in. So out of that 10 grand, since Bryce contributed 60%, he's going to claim 60% of the taxes on his return, and Darlene's going to claim 40 on hers. So 4,000 is going to go that way. This, of course, talk to your accountant about anything that you want to deal with on a tax system. But this is the way that CRA basically says it should be broken down. And that's how we want to look at where the tax is paid while everybody is alive and things are going well with this. Any points you want to add on that, Clint?
Yeah, so a reminder, these non-registered accounts, unlike an RSP or a TFSA, these joint accounts or non-registered accounts, it's like a pay-as-you-go system for tax. So every year there could be some taxable events that you're going to have to claim. And CRA is pretty clear that they want you to claim them in proportion of the folks that contributed the capital, which means you can't optimize the ratio. This is not income splitting. Income splitting for pensions, 1 year you can do 50-50. If it's more beneficial the next year, do 60-40. Your accountant can play with the numbers. That's permitted. Not the case with joint accounts. It's supposed to be based on the proportion of capital contributed. And this is a key point there. You can see at the bottom. Financial firms typically only issue the T5, which is the tax slip that'll have all the details of the tax that needs to be reported for the year. They normally only give it to one person. There's typically one social insurance number. That's the prominent one on a joint account. So if you're kind of trying to divide it, it's important to know that only one of those folks might get the T5, and the accountant might need to make a copy and have a couple of notes there to do an appropriate filing. So that's more a logistics item. You'd want to make sure your accountant gets the T5 and both partners are able to file accordingly. But that's the first portion. And then the key here, Kevin, is what if people don't follow that rule? What if they say, you know what, I contributed 10 grand, the other person contributed 90, but we're going to do 50-50 anyway when it comes to splitting? What can happen?
Yeah, well, basically what CRA can come back and do is if they find out that, I've put in all the money and somebody else is claiming all of the income for it, the government can't come back due to attribution rules and go after you for it. They can say, no, you shouldn't have had it done this way. You now have to refile these, and you are going to have to pay the appropriate tax, each party that contributed reasonably as to how they put the money in there. So again, doing it the way that CRA wants is always the safest matter to deal with. That way you don't have to worry about ever having attribution rules come back to you. And that's a big one where you're going to have to possibly pay more tax than what you're dealing with at this point in time.
Yeah, and this is the basics there for the ongoing tax. We'll flip the slide here, talk about what happens when one of the partners in this joint account passes away. Well, the key there is there's going to be a deemed disposition. That's fancy words that simply says it'll be treated as if all of your portion of that account gets sold. So the money does roll over to the surviving account holder, rolls over to that individual. It bypasses the estate, which is some of the benefits of the joint account. But the estate of the person that passed away, they're going to have to claim the tax on their portion of the account. It'll be as if they sold their portion of the assets. So there could be a tax bill there, right, Kevin?
Yes, that's exactly. You could possibly see it, depending on how the joint account is set up, that one party all of a sudden, it's like I say, it's not a registered account where everything flows through automatically and you don't have to worry about the tax portion there. There is a tax portion that the deceased is going to have to pay on because there's possibly been gains out of it or more income that's come in. That has to be paid by the estate going forward for it. Unless, as we see the exception here, spouse. You can get a spousal rollover. That is possible. That's one thing to note, that the estate of the former owner pays the tax on that portion. So except for the spouse or the spousal rollover, any other combination that you're looking at is probably going to have to deal with a tax situation.
Yeah, so if you have a joint account with yourself and one of your adult children or a sibling or anyone not the spouse, when you pass away, your estate's going to have to deal with the tax on your portion of the assets there. And then we have a common situation, or this assumes that the joint account was set up at the beginning. What if you have money initially in an account in your name, and then you just add another name to the account? That can be a little more complicated. The taxes there will vary. We'll dive into that. I'll let you lead us off here, Kevin. What would be the first thing? If I have money in my name and then my brother gets added to the account, what can happen?
Well, typically what was going to go on is that if you say, and we can use an example again, you had 100,000 in there and then you add your brother to the account. Theoretically speaking, if you put in a specific amount at 50 and now it's 100, you have a deemed disposition because you've changed technically the ownership of this. It is no longer just in your name. It is now in two names. So since the account has been changed, the government feels that, okay, you've changed the account. Now we are going to have to tax you on the money that you had before because it's no longer a single account in your name. It's now joint. You have a deemed disposition. There is now taxes that are owed on that. And those taxes are going to have to be paid. That's the big factor there. The original owner, you in this case, is going to be paying tax on the proportion moved over, and going forward, you're going to be taxed proportionally. So that's one thing to notice, that going forward, now you've got something different, but that's the main thing with that sort of a scenario. Again, we're dealing with joint. That's sort of a scenario depending on whether it's spouse or not. And in this case, as we mentioned, beneficial owner, not spouse.
Yeah, so the key here is the beneficial ownership. And you're correct. If the new party being added to my account is going to be a beneficial owner, they're taking ownership in those assets as if I'm selling them the assets. So there will be a tax on my part. And then going forward, we can split the income because they're technically a beneficial owner. And of course, there is special treatment there for spouses. You could add a spouse's name to the account without as much complication. But what if they're not a beneficial owner? This gets a little complicated. If you just wanted to add a name to an account, where we often see this, at least where we see it, is if you had an aging parent and they want to add their adult child to the account for administrative purposes. So they need a little bit of help handling the paperwork, dealing with the ins and outs of the account. So they add to the investment account one of their adult children, but their adult child is not a beneficial owner. So they're not gaining ownership in the assets. So at that point, there's no deemed disposition because all the assets still belong to the parent. The child does not get ownership in a chunk of the assets. But that means the original owner, in our example, the parent, has to pay all the tax going forward. So they can't split the income because the child's not a beneficial owner. They got to claim all the tax. And then when that original parent passes away, it can get complicated. Normally in a joint account, the surviving owner just inherits all the funds. It just rolls right over, bypasses probate. That might not be the case. There could be some complications there because they're not a beneficial owner. It might actually go through the estate. So you'd want to be careful here. You'd certainly want to chat with your lawyer, chat with your accountant, make sure you understand all the ins and outs before you'd set this up. But simply letting you know it is an option, it is a possibility. And of course, spouses do get special treatment. You can see that kind of throughout all the slides here. There's always an exception for the common law partner or for the spouse. Anything you wanted to add, Kevin?
Yeah, no, I think that covers a lot of it. But as we can see, when you're dealing with non-registered accounts, whether they're joint, whether they're single, the taxes and who pays become a lot more complicated than they are with registered accounts. With that designation of a beneficiary in a registered account, a lot of this bypasses probate, goes right through from one party to the other. But as you can see, money that's taxed every year all of a sudden comes into play, and anything that goes on with that, I think, as we've shown with this joint account, is definitely something that is going to be a little more complicated, which again, we suggest consulting your accountant to make sure that you're all set up in the right way, and making sure you know the ins and outs of why you're setting it up and how this is going to affect you going down the road. Whether it's with the spouse, whether it's with the parent, whether you're doing it with family members or something along those lines, it's very important to know where those taxes are coming from so that there's no surprises coming to you. Any last points you want to add, Clint?
That's very true. Very true. Often folks, and this isn't a negative sense, but the idea is, just add a name to an account and we'll save tax or probate down the road. Not the case. You certainly want to make sure that is a very strategic, well-planned addition to the account, and talk to the lawyer, talk to the accountant, make sure it's done correctly. Any questions for us? And we're always happy to take questions. Simply go to chatwithclintonandkevin.com. Maybe you got a topic for a future show, or maybe you have a few questions you want answered about your situation. We are happy to help out. Chatwithclintonandkevin.com. You can see it at the bottom of the screen there. So that'll be it for today. We'll be back again soon with another video. Until then, everyone take care and stay safe.